Common stocks are one of the most popular and powerful ways for people to invest and build wealth over time. But what exactly are they, and how do they work? In simple terms, a common stock represents a share of ownership in a company. When you buy common stock, you're not just purchasing a piece of paper, you're buying a small slice of that business. This means you have a claim on part of the company's profits, usually in the form of dividends, and you can benefit when the company's stock price rises. For example, if you buy shares of a company for £10 each, and the price later increases to £15, you can sell them and earn a £5 profit per share. However, the price can also go down, which means there's always some risk involved. Common stocks are traded on stock exchanges such as the London Stock Exchange or the New York Stock Exchange, where buyers and sellers meet to trade shares every day. The value of these stocks changes constantly based on factors like company performance, economic trends, and investor confidence. One big advantage of owning common stock is voting rights. Shareholders often get to vote on major company decisions, like electing board members or approving mergers. This gives investors a voice, even if it's a small one, in how the company is run. Investing in common stocks can be an excellent long-term strategy for building wealth because historically, stocks have provided higher returns than savings accounts or bonds. For instance, over the last few decades, the average annual return of major stock indices, like the S&P 500, has been around 8 to 10%, though returns vary year to year. But it's important to remember that with higher potential reward comes higher risk. Stock prices can fluctuate sharply due to market volatility, political changes, or unexpected events. That's why many experts recommend diversification, owning shares in different companies or industries to reduce risk. Some investors buy individual stocks, while others prefer to invest through mutual funds or exchange-traded funds, ETFs, which allow you to hold multiple stocks in one portfolio. So, why do people choose to invest in common stocks? Simply put, it's one of the best ways to grow your money and build financial independence. When companies succeed, their shareholders benefit through rising stock prices and dividends. Some famous entrepreneurs and investors, like Warren Buffett, have built their fortunes by smartly investing in strong, well-managed companies and holding their stocks for years. In the UK, more people than ever are turning to the stock market thanks to easy-access investing apps and platforms that make buying shares as simple as using your phone. Whether you're a beginner or an experienced investor, understanding how common stocks work helps you make smarter decisions and avoid emotional mistakes when the market moves up or down. In short, common stocks represent ownership, opportunity, and a little bit of risk. But for those who are patient and strategic, they can be one of the most rewarding paths to long-term financial success. So next time you hear someone talk about owning shares, remember, they're not just betting on numbers. They're investing in real companies, real innovation, and their own financial